Welcome to The Explainer. Today we're taking a close look at a real powerhouse in the investment world, the Fidelity 500 Index Fund. You might have seen its ticker, FXAIX. We're going to break down exactly how it works and why so many people see it as a key piece for building wealth over the long haul.
All right, let's start with the huge question. How can you, just one person, invest in 500 of America's absolute top companies, all at once, with a single click? It sounds kind of complicated, right? Well, the answer is surprisingly simple. And to get to that answer, we really need to get to know the fund we're talking about today. So let's get right into it. What is FXAIX? Okay, so at its heart, FXAIX is what's called a mutual fund. And all that really means is it's a giant pool of money, right? A bunch of investors like you and me put our money together to buy a whole portfolio of stocks. This particular one is from Fidelity Investments. You've heard of them. They're one of the biggest names in the game, and it was built to do one very specific job.
And that job? Well, it's laid out right here in its official objective. The fund's goal isn't to hunt for the next big thing or try to perfectly time the market's ups and downs. Nope, it's much simpler. It just wants to match the performance of the entire U.S. stock market. Basically, it's built to give you the market's average return. That's it. Nothing more, nothing less.
So how does it pull that off? Well, it tracks a benchmark, and not just any benchmark, it tracks the big one, the S&P 500 index. Now, you've probably heard of the S&P 500. It's basically a list of 500 of the biggest, most influential American companies. It's the standard for measuring how the U.S. stock market is doing overall. And since this fund's whole job is just to copy that index, we call it, you guessed it, an index fund.
Okay, so here's the really important part to grasp. When you buy just one share of FXAIX, you're not putting all your eggs in one basket, you're literally buying the whole basket, a basket that holds tiny little pieces of all 500 of those huge companies. This gives you instant diversification, which is just a fancy way of saying you're spreading your risk out. And that is exactly why a fund like this is often the core, the foundation of a solid long-term investment plan. All right, so let's get into the mechanics. How does this fund actually work? It uses a specific strategy that honestly is super simple but also incredibly powerful. It's an approach that completely changed the game for regular investors. The strategy is called passive investing. And what that means is there's no hotshot fund manager in a fancy office trying to pick the next winning stock. No, the fund just copies the index. It's on autopilot. Now, this comes with a really important risk you need to understand. If the S&P 500 has a bad day or a bad year and goes down, this fund is designed to go down right there with it.
Now, this is the complete opposite of an actively managed fund. With those, you have a whole team of analysts working around the clock trying to outsmart the market. But a passive fund like FXAIX, it just accepts the market's return. The whole idea here is that trying to beat the market is really, really hard, not to mention expensive. So for a lot of people, it's just better to ride the wave, good or bad.
And here's a little peek behind the curtain, something you might not know. To copy the index as efficiently as possible, the fund doesn't actually have to own every single one of the 500 stocks. Instead, it can use a smart technique called statistical sampling. It just buys a representative mix of stocks that perfectly mirrors the behavior of the full index. Pretty clever, right? Okay, now we get to one of the biggest, if not the biggest, advantages of this whole passive strategy, the cost. Think about it. Since you're not paying that team of expensive analysts to do all that research, the fund's operating costs can be shockingly low. This whole low-cost idea has been a total revolution in investing, making it so much easier for millions of everyday people to build wealth over time.
And when I say low, I mean incredibly low. We're talking about an expense ratio of just 0.015%. Let me put that in real terms for you. For every $10,000 you have invested in this fund, the fee for the entire year is just $1.50. $1.50. It's almost nothing.
And this table here really drives the point home over the long run. Look at this. Over an entire decade, on a $10,000 investment, the total cost is just $19. That's it. And keeping those costs down is absolutely critical for your long-term growth because it means more of your money stays in your pocket, compounding and working for you.
And it gets even better. On top of those super low operating costs, there are zero shareholder fees. What does that mean? It means it doesn't cost you a dime to buy shares, and it doesn't cost you a dime to sell them. That 1-2 punch of low internal expenses and no trading fees is a massive reason why this fund is so popular.
Okay, so we've talked a lot about the good stuff. But of course, no investment is a sure thing. There's always risk involved. Low costs and diversification are fantastic, but you have to understand the potential downsides and look at how the fund has actually held up when the market gets choppy.
And the fund's own documents are super clear about the risks. You've got your basic stock market volatility. The whole market can just have a bad day. Then there's the risk that a single huge company in the index does poorly, which can drag the fund down a bit. And of course, there's that passive management risk we already talked about. If the market tumbles, this fund is going right along for the ride.
And this chart right here, it really makes that risk real. You can see it clear as day. Look at the down years, like 2018. And wow, especially 2022, when it dropped over 18%. That can be tough to stomach. But then you see the other side of the coin. Look at the massive up years, like 2019, with a gain of over 31%. That's the deal with investing in stocks. You have to be ready for the ups and downs to get those long-term returns.
But now, let's zoom out and look at the average returns over time. This is where you really see the fund delivering on its promise. Just look at how closely it hugs the performance of the S&P 500 index over 1, 5, and 10 years. It's almost identical. That tiny sliver of a difference you see, that's basically just that ultra-low expense ratio at work. The bottom line is, this fund does exactly what it says it's going to do.
All right, let's bring this all together. What's the big takeaway from all this? We've looked at what this fund is, how it works, what it costs, and how it's performed. So, how should you think about it as an investor?
Really, it comes down to 4 huge points. 1, you get instant diversification across the biggest players in the U.S. economy. 2, it's incredibly cheap, which means more of your money stays yours. 3, it's simple. It's a passive, set-it-and-forget-it kind of approach that you don't have to overthink. And 4, it has a rock-solid track record of doing precisely what it's designed to do: match the market.
Which leads us to one last really big question for you. When you take its broad diversification, its incredibly low costs, and its simple strategy, could one single fund like this actually be the foundation for your financial future? It's something to consider. And that's all for this edition of The Explainer.